Hello, everyone. We still have some people jumping in, but just for sake of time, since we're at top of the hour, I'm going to go ahead and kick it off and get started with our webinar today. I usually start with a quick introduction, who we are, GBS Retire, what we do, what we specialize in, how you can utilize us as a resource. So before we dive into the topic today, just a quick reminder, GBS Retire, we are the retirement division of GBS Benefits and the Levitt Group. So if you are familiar with Levitt Group or Levitt Retirement Partners, we're one and the same. We are a resource for you, so feel free to reach out with questions. There's a lot of different things we'll cover today around maximizing employer stock and equity award that can spur a lot of individual questions. So don't hesitate to reach out, submit questions in the Q&A as we go, and I'll make sure you have our contact information and a way to schedule an individual meeting with us if you do want to go further into your specific situation. My name is Rocky on the team, certified financial planner. Been doing this for about 5 years now. Most of my time is spent doing group meetings as well as individual meetings and retirement planning along the whole scope, the whole spectrum for people just starting out in their careers to people who are retiring, business owners selling their companies, a lot of different situations that we see. So don't hesitate to reach out as questions come up. Really excited about this webinar this month around maximizing employer stock and equity awards. This is a more of a niche specific topic that we decided to cover in our webinars because we do get these questions a lot. And I was going through the list of attendees today and the companies that you work for. There's a good mix of different types of equity plans, types of employer stock. So we'll be covering things at a very high level, but I'm excited to dive into some of the details around employer stock and equity awards today. Like I said, I'm monitoring the Q&A, so feel free to drop any questions in there, and then I will take some time at the end if we don't have time to get through them all during our time today. Spend some time at the end answering those questions. The big takeaway that we'll go through is just a brief overview of the different types of equity compensation, different types of equity awards that you may have or have heard of, maybe in the future you or your spouse may have as well. So it's a good idea just to review the different types of equity compensation. The specifics of each, things to keep in mind, as well as taxation risks and strategies to reduce those risks, right? One of the biggest factors around equity awards and different types of company or employer stock is the taxation. The taxes are a big key, but we'll talk through that, kind of some strategies in the different types of equity compensation to help mitigate that. But this is not going to be a specific stock or company prediction, right? It's not going to be tax advice. It's not going to say hold everything forever. I'm not going to say sell everything tomorrow, right? Anyone giving universal advice around any given areas is typically either lying or selling something, right? Neither of those are my purpose today. So I'll just provide general education and some things to think about around your equity compensation or awards. So first of all, just breaking down equity compensation real simply. I want to talk a little bit about why companies offer equity and why we, as employees, enjoy and like that equity compensation. It should make sense, right? Companies like to offer some form of equity compensation for a couple of reasons. Two of the main ones that we see here: to attract and retain talent. Hopefully that makes sense. In a lot of cases, especially with startup technology companies that don't have necessarily a lot of free cash flow, may struggle to attract and retain top talent if they can't pay a competitive salary for that. So in many cases, they tend to offer equity compensation, regardless of the type, to incentivize better talent to join the team. It looks good, and the company doesn't have to pay anything out on the bottom line in terms of cash out to the employee or executive. So it's definitely a benefit and added compensation level that can help to attract talent, as well as align with company performance, right? It makes sense that if you have some form of ownership in a company, you are going to try and work a little bit harder, because as the company does better, as profits increase, your share of that company increases as well. And if you actually have some say, albeit how small that is, to increase the performance of the company, then it usually helps to incentivize better performance over the long term. So those are two big reasons. Obviously, there are some others, but two of the big ones that I thought of when it comes to why equity compensation is an option and why we see that in different areas of the market. We love equity for a number of reasons. Oftentimes because it looks good. Looks good, it's nice and shiny, it's additional compensation that comes to you, has endless upside. I put it in quotations there because the endless is a little bit nuanced. We think there's endless upside to all these companies, to all these investments, and certainly some of them do have the potential of extreme growth, significant growth and appreciation within the stock. But in a lot of cases, we don't see the NVIDIA style appreciation in the stock all too often. So when we think of it as endless upside, Sometimes it's a little bit of going into the next point there, emotional attachment to the company, right? It's a little bit nuanced there. But emotional attachment is often where those big mistakes come from when it comes to equity compensation, right? We get emotionally attached, and I'll talk more about this here in a minute, but emotionally attached to the company, and that can sway our decisions and implementing those decisions when it comes to deciding around the equity compensation. Participation with company profits, I already mentioned that. That is a big benefit, right? It's no longer just with the higher ups and the owners of the company. They make all the money on company profits, and then we as employees just sit here and don't participate in that. If we have that form of equity compensation, we can participate in those profits and have a little bit of say as well on how the company does. So it's a great benefit, great compensation if you have the ability to have equity compensation through your employer. It can be very beneficial, but there are, of course, some things to consider that I'll go into. There's a few different types of equity compensation. I do want to break these down because it can be very confusing. There's a lot of different specifics when it comes to equity compensation. A number of them here, this doesn't show all of them, but I'll go through a few of these in a little bit more detail. Like I said, I was going through the list of who's on today, and most of you will fall under either the RSUs, stock options, or maybe the profit interest bucket. But I'll go through some of these at a fairly high level. So restricted stock units, very similar to restricted stock awards, which is a bit less common. So restricted stock or RSUs are pretty common. Stock options, both non-qualified and incentive stock options, ESPPs and employee stock purchase plans or employee stock option plans, profit interests, SARs, which are stock appreciation rights, and then phantom equity as well. So there's a lot of different types of equity compensation, and it can get pretty detailed. So obviously we don't have time to go into all the nitty-gritty details about each of these options, nor do we have the option to go into details around your specific employer. Similar to a 401k, different stock plans have different rules associated with them. They have a little bit of flexibility in how they can structure that. So definitely makes sense to review with a financial advisor of some kind your specific equity grant agreement to dive into the nitty-gritty details. But I'll cover a high-level overview of a few of these that are the most common. So restricted stock units are essentially shares of the company that the company grants to you, essentially just gives to you as an additional form of compensation. Typically, those shares have a vesting period. In most cases, when it comes to equity awards or stock awards, there is a vesting period that's similar to a 401k, means ownership of the funds. So ownership of the shares that vests over time, very commonly 25% for 4 years or 20% over 5 years. No action is required to receive these on your end. Essentially, it's just an additional form of compensation that your employer gives to you, which can then turn into, once it's vested, stock that you can then appreciate with the profits and revenue of the company. Initially, when you're granted the restricted stock unit, that's not an actual share that you will receive at that time. That has some implications when it comes to the tax side. So really, it only becomes yours when it vests. Now, the IRS has specific rules around taxing compensation, and when it becomes quote unquote yours, that's where they call it the substantial risk of forfeiture. When the substantial risk of forfeiture is removed, so when these restricted stock units vest, that's also around the same time as the company transfers those shares to you. That is the first point at which taxes may be realized. Once vesting has occurred and you have received those actual shares, then you receive tax at ordinary income. So at that point, depending on the value of the share, that is how much you are going to realize ordinary income tax at that time. So the shares, nothing is taxed as they're the restricted stock units, but once it vests and becomes your shares in the company, that is when it is taxed. So that's the first thing to consider. Whenever something has a vesting period, typically once the vesting is over, that is when it is taxed. In this case, it's taxed at ordinary income. So whatever your value is of the shares when that becomes vested, that is added to your income as ordinary income tax. Now, that can pose a little bit of a problem, right? If you have, say, $50,000 of these restricted stock that gets vested, that's going to be $50,000 added to your taxable income, but that's not actually paid out to you as cash, right? So what we'll see with a lot of these different equity agreements is there is a difference between liquidity and the taxable event. So in this case, the taxable event often comes before liquidity, which can cause a little bit of a by income tax season if you're not prepared for that. After that point, so if you decide to hold on to the shares after they're transferred to you, then any growth at that point from then on will be taxed as capital gains. Short term if it's less than a year, long term if it's greater than a year. So more preferential tax treatment after the shares have been transferred to you as you participate in the growth or loss of the company from that point forward. The main mistakes we see around RSUs come down to not planning for the vesting period and the income liability, tax liability that can impose. So doing nothing at vesting to improperly plan for that, as well as holding out of loyalty. This comes back to kind of that emotional component when we're tied to an employer and have that emotional component within the equity compensation. We shouldn't specifically be holding the position out of loyalty, right? We need to have a plan behind it, and we need to stick to that plan regardless of what our emotions tell us to do. So very simply, that is the restricted stock unit. The next most popular form of equity compensation comes down to stock options. Like I showed on the previous slide, there's two types of stock options that we're going to talk about today. The first is non-qualified, and then incentive, which also is a qualified stock option. Non-qualified stock options are a little bit simpler on the tax side, but really quickly, a stock option is essentially like it sounds, the option to purchase a share at a specific price. We call it the strike price. So if I have an option to buy a share at say $1, the fair market value of the option, maybe when it was granted to me was $1, I can then purchase that stock for $1 at any point in the future before expiration. So let's say I wait 4 years, the fair market value of the stock is now $2. I can still purchase that share at $1, and then my intrinsic value right away is $2. So there's an automatic, pretty much immediate increase or return on that once I purchase that option. One of the big differences between stock options and the RSUs is the cash outlay upfront. You actually have to fork over the cash to purchase the stock. You exercise the option, purchase the stock at that strike price, and can immediately have a return on that, which can be great. But again, we're realizing at this point, which I'll talk about in a minute, the tax implication. We're realizing some ordinary income at that point. Now, different from the RSUs, we have cash outflow, but an income tax liability that we may have to pay. So again, the liquidity component is a big factor to consider and to keep in mind. Timing is also very important when it comes to stock options. When it comes to taxes around non-qualified stock options, try and keep it as simple as possible. When you exercise that stock option, you have your exercise price and the fair market value of the company of the stock at the time of exercise. That difference, that spread, is going to be taxed as ordinary income. So that difference is added to your income and then taxed in that year it's realized. But again, if it's, for example, a private company, that's a little bit harder to sell those shares once you have exercised those options. That can be a taxable event without any liquidity. So that becomes a little bit hard to plan for. When it comes to stock options, I always suggest really looking into the equity grant agreement that you have to see what type of strategies that we can implement, right? One of the more common ones is gradual exercising over time, right? So instead of, if it's, let's say it's $100,000, if you have $100,000 of the difference between exercise and fair market value, that's $100,000 onto your taxable income for the year. If you spread that out over 5 years, that's much more manageable. If your plan allows that, you can typically do gradual exercising over time so that you don't realize all that income in 1 year. The benefit of exercising maybe a little bit earlier rather than later, though, is all that growth going forward, if there is growth, is all taxed at capital gains, short-term or long-term capital gains. So common mistakes here with non-qualified stock options, waiting too long, because then sometimes you run into issues of short-term capital gains versus long-term capital gains, depending on what happens at that point. There's an example I'll give you. There was a gentleman I was working with who had non-qualified stock options, pretty significant amount, waited a little bit too long. And so not only are they expiring within a year, but the company is also potentially going to be bought out. He's sitting on these options that could potentially be a lot of value. He could exercise them now, but if it gets bought out within a year, that's all going to be ordinary income, regardless of what the fair market value is today. And so that's going to be a significant income tax liability, where if he had exercised them a little bit sooner, then you would be able to realize at least some of that as long-term capital gains, as opposed to paying taxes at 35%, which is what he's looking at. So that's a key there as well. And then the last point there, exercising without a plan, is super important. Within every type of equity grant agreement, you need to have a plan that aligns with your long-term financial goals. And then sometimes this is the hardest part, executing that plan, because sometimes our emotions get in the way and make us wait a little bit too long, right? Wait a little bit to exercise as opposed to exercising today, or holding a little bit longer when we probably should have sold. Depends on the company, how often valuations happen, and how often the opportunities are to sell, but you can often exercise a little bit at a time and then even sell a little bit at a time. So looking into the specific equity grant agreement you have is very important. This on here says not considering early exercise with 83B election. Sometimes the plans will offer an early exercise option, where right as the stock options are granted, you can do what's called an early exercise those potentially before they have vested. Use an 83B election, which essentially means you're realizing that income at exercise, which is often very low in terms of exercise to fair market value price. And then everything going forward is long-term capital gains or capital gains. So looking at those different options to see what strategies you can employ with your specific equity grant agreement can make a big difference in the long term. Now, a little bit different from non-qualified stock options. Incentive stock options are very similar, right? You have the option to purchase a share at a strike price. You have to cover that initial cost to purchase the share and exercise the option. The main difference between non-qualified and incentive stock options is the tax liability when you exercise. So after everything has been vested, if you exercise an incentive stock option, there is no ordinary income tax liability that you have. There is what's called the alternative minimum tax. And this alternative minimum tax is really the biggest area to plan around when it comes to incentive stock options. The alternative minimum tax, just real quick, we don't have time to go into the details of that, but it's a separate calculation that runs alongside your ordinary income tax that says after your regular ordinary income and other income sources, we're going to add on additional types of income like incentive stock options. After that calculation, if the alternative minimum tax liability is larger than the ordinary tax liability, then you pay the larger amount, the alternative minimum tax. Which if you have a significant amount of stock options or a significant difference between your exercise price and the fair market value, that can be a significant tax hit, even though they are incentive or qualified stock options. So it's very important to plan around as well. Common mistakes very similar to non-qualified stock options. The biggest thing when it comes to stock options is to have a plan and to exercise that plan consistently. The last one I wanted to talk about just very quickly before we get into some risks and strategies around these equity grant agreements is profit interest. Profit interest, which we see in a lot of cases when it comes to private equity purchasing certain types of companies, is essentially a share in the profit of the company from that point forward. So if private equity comes in and buys out a company, they may offer profit interests to certain employees, and then those employees participate in the profits of the company going forward. And then whenever they have another liquidity event, they evaluate how much the company has grown between those 2 points and pay out the profit interest based on that growth. And so it's not exactly stock in the company, but you do have a share of the growth in the company from that point forward. If this doesn't apply to you, just keep in mind and remember profit interest, 83B election. Okay, if you remember those 2 things, profit interest means 83B election, then you should be fine from a tax standpoint. We see a lot of cases where people get those profit interests, don't file that 83B election, and then it's taxed as ordinary income as opposed to capital gains at the payout date. So that is a very important distinction around the tax side of profit interests. All right, so what are the main risks when it comes to employer stock? Right, I've highlighted a couple of them. Taxes are a big part, but this is one that's often overlooked as well. Over-concentration. We know when it comes to our investment portfolio, whether we're looking at our 401ks, IRAs, or just our outside investments, we know we shouldn't have it all in one company, right? We know we shouldn't have a large percentage of our investments in one company because that company risk is very high. But sometimes when it comes to our employer, we don't think about it the same way. We think our employer is safer than other companies out there. And it may be. I'm not saying that any one of your employers today is going to go out of business by any means. All very great companies, but we need to be thinking long term in conjunction with our entire financial picture, right? We need to be making sure that we can diversify and don't have too much concentration in any one specific area. Another point that I like to highlight as well, you have your income, often your benefits, and even your investments. If you have equity compensation, all tied to one company, that's a lot of concentration. And yes, I also want to acknowledge that a lot of wealthy people have made their wealth from some form of concentration. So a little bit of concentration can be good. We just want to make sure it's strategic and intentional, and that you're not unintentionally over concentrating to something that is higher risk than you would want. Right? If you're younger, oftentimes that concentration makes a little bit more sense because you can afford to take more risk. Then as you get older, closer to retirement, your risk tolerance and ability to handle that risk decreases, and we need to be shifting a little bit more and diversifying. The other risk, which I couldn't resist putting in a picture like this on there, is the tax traps. It's very easy to not think about those tax implications and those tax hits when they come, whether that's vesting for restricted stock units, the stock options, and the difference between exercise and fair market value, and those tax traps that can come up very surprisingly, right? And oftentimes, if we're dealing with a very large amount of equity, right? Let's say your stock options are 50 cents per share, and now the company's valued at $10 per share. That's a significant difference that can cause huge tax spikes throughout the year. It's okay if we can manage that and we have a plan for that, right? We just have to make sure we're aware of what the tax implications are going to be and then plan for that. Right, poor timing can intensify the tax issues. I mentioned the gentleman that I was working with their non-qualified stock options, where he waited maybe a little bit too long, and now we're dealing with all 100% ordinary income tax or short-term capital gains on that amount. That's going to be, in that case, it was a fairly large amount, hundreds and hundreds of thousands of dollars in tax liability for the year that could have been reduced if there was proper planning in place. And the big one there that I've already mentioned, the liquidity and tax liability doesn't always happen at the same time. If it's a public company, it's typically very easy to sell those shares. Right? You just go on the open market, sell the shares to another investor, and then you can have that liquidity to cover the taxes. If not, and it's a private company, a little bit harder to sell those shares at times, then you may be having to find other options and other ways to pay those taxes, because the taxes typically don't wait. The IRS wants that money, unfortunately. The last risk I like to highlight is the behavioral risk. And I already mentioned this, alluded to this earlier around your emotional attachment to the employer stock. It's important to separate that, right? Separate your emotions from your investment decisions. One of the biggest, and this is one of the things that Warren Buffett and Charlie Munger at Berkshire Hathaway did very well. They were essentially the perfect example of separating your emotions from your investment decisions, being able to invest more when the markets are down and being able to hold out when the markets are up and not invest more at an inopportune time. So the key here is to have a plan and to execute that plan without having our emotions get involved. Waiting for the right time seldom comes and often leads to just procrastination when we think it may be patience, often leads us to do nothing. And then you get to the point where the options are expiring and we're forced into a decision that maybe we didn't want to make. So keeping an eye on that and at least being aware of that is very important. And I'll end this slide by saying doing nothing is a decision, right? Doing nothing is a decision. It's a decision to keep your risk where it is today and not make a change. Sometimes that can be good. Other times, if that's contrary to your long-term plan, can be bad and detrimental. So lastly, I'll wrap up with some strategies. What are some strategies that we can implement to help with those risks? The biggest one is diversification, right? Being able to diversify your risk. And it's okay to have a little bit of concentration, right? I acknowledge people like Elon Musk, one of the wealthiest man in the world, probably will be the first one to reach $1 trillion in net worth. He has a lot of concentration in just a few companies. That's great, but what we also don't see are all the examples of people that had insane amount of concentration. Companies went out of business, and then they don't have the net worth that they thought they would. And so understanding that and making sure you're comfortable with the concentration risk that you have, and then starting to diversify away from that when it makes sense. We typically don't have to sell everything just to reduce our risk, right? We can reduce our risk by selling a little bit at a time over time. Of course, we have to look into the individual equity grant agreement to see what's allowed in terms of selling over time. But partially selling or systematic selling acts like dollar cost averaging. So when we're contributing to our retirement accounts or investments, we dollar cost average over time, and that reduces our risk. Similar with our concentrated investment positions, we want to reduce risk over time. That can help smooth out the tax burden as well as allow you to continue to participate if the investments continue to go up. Being intentional about where you're reinvesting as well is very important. A lot of these companies that offer equity compensation are technology companies. And if we look in the S&P 500, a large percentage of the S&P is technology companies. So if you think, oh, I'm diversifying by selling some of my employer stock and moving it to the S&P 500, VOO or BTSAX, whatever you invest in, you're moving from technology potentially to more technology. And so it's not exactly providing that diversification that you may want. So being a little more strategic on reinvesting in areas of the market that may be less correlated to your employer. If your employer is in a technology, then maybe looking at consumer cyclical stocks, consumer staples, defense positions, energy to help diversify into other areas of the market. So diversification is a big strategy to help reduce your risk. Taxes can be, like I said, the silent killer and really inhibit your returns when it comes to equity compensation. So there are a few ways to help mitigate that. And the biggest one is planning. We want to think multiple years, so year after year after year, not just paycheck to paycheck or 1 year at a time. If you meet with a tax accountant to help review what some of these decisions could result in it from the tax perspective, they're often going to look 1 year at a time and not look long term. Right? We want to be thinking long term, year after year after year. How can we reduce our tax liability and make sure we have that liquidity available for the stock option or whatever, and also for the taxes that will be owed? Oftentimes, with the first and second bullet point there, we can coordinate some of these income spikes with strategic tax deductions. There are different types of tax deductions that we can maybe lump up in every other year. For example, charitable contributions are a great example. If you contribute $10,000 a year, as an example, to charities, maybe lump that into 2 years into one. So you can do 20,000 this year, zero next year, take the standard deduction next year. That gives you a little bit more of an itemized deduction to offset some of those income spikes. So there are ways to strategize around that based on your tax situation. And I'm not a tax professional, I can't give tax advice, but there are some ways you can think outside the box. The big beautiful bill that Trump signed into law has what's called bonus depreciation. That's something that's been around for a little bit and that extended it. There are some strategies using that bonus depreciation in order to offset a large percentage of taxable income year to year. So there are some strategies that we can look into and utilize to make use of that bonus depreciation to reduce your taxable income. That can be significant. Most of the time, that starts to make sense once you're in the 300,000 to 400,000 or above range, because with all those strategies, there is some form of cash outflow that is required in order to take advantage of that. So if you want to go more into those details and you think that applies to you, reach out. We can chat through what those strategies would look like. And the last strategy when it comes to reducing your risk, when it comes to equity compensation, is making sure that your plan is in line with your long-term goals. Everything comes back to our overall financial plan and our goals, and we want to make sure that equity compensation complements that. Yes, it can be a great option. If your company goes to the moon and profits skyrocket, you can make a lot of money on that. But there's a very famous quote that I heard recently where someone said, only invest in your equity compensation what you can afford to lose. And if you can't afford to lose it, if your overall financial plan cannot continue if everything goes to zero, then we need to rethink your strategy, right? You can be a little bit sometimes on the conservative end to make sure everything lines up with your financial plan. And like I said, if you're younger, if you're able to stomach that concentration risk, sometimes that can be okay as long as it doesn't derail the rest of your overall financial plan. So like with everything that I talk about, it all comes back to our financial plan, all comes back to our goals and making sure everything meshes together and works long term. So I know I went into a lot of details and everybody's equity compensation is structured a little bit differently. So if you want to schedule a time to review your specific equity grant agreement, scan that QR code on the left. We can go through that with you and make sure that you're understanding everything, all the details within that, and that you have a plan in place going forward. And then, of course, keep an eye out for our upcoming webinars over the next couple months. Excited about this year's webinars because we are doing topics like this that are a little bit different from your average financial wellness webinars. If you have specific questions related to your situation, schedule a time or reach out to us via email or phone number. And with our little bit of time that we have left, I'm happy to stay on and answer any questions in the Q&A. So let me pull those up here. All right, one question that I have here is, let's see, what are ways to finance stock options? Yeah, that's a fantastic question. So a great question around financing stock options because there's that liquidity outflow. And if that's too much, if you don't have the cash on hand to fund those stock options, then we have to look into other ways to finance that. The most common way of financing stock options is what's called non-recourse lending. Non-recourse lending are essentially institutions out there that will fork over the cost to purchase those options. And then they, of course, take either a percentage or charge an interest rate on the amount that they are paying. That can cover the actual purchase or the exercise price of the options, as well as the tax liability that comes with that. And then, of course, they're going to be compensated based on their risk around the company. That can be a great way to exercise those options without having the cash come out of pocket. Of course, those companies are going to do a lot more due diligence to make sure it's not overly risky on their end. And the riskier it is, typically the more expensive their terms will be. So non-recourse lending is what we typically like to look at for funding those stock option purchases. All right, Mary had a great question. If your company offers RSUs but is not a publicly traded company, do you have to wait until this company decides to do a stock buyback in order to turn vested RSUs into actual money? Great question. And for private companies, like I mentioned, it's a little bit harder to find liquidity, but oftentimes they do offer different types of liquidity events. You don't typically have to wait until like they get acquired by a different private equity or whatever based on the structure. They will often offer strategic buybacks, like you mentioned, in order to turn that into cash that you can then deploy elsewhere. But there are also more and more now, it's more and more popular to find secondary markets for those shares. So depending on if your company allows you to look to secondary markets for those stock units or stock shares, then you may be able to look on the secondary market to sell those to another investor. Again, that depends on your company and if they allow you to do that. If not, then it would really just be the stock buybacks that are offered internally. Great question. Next question is, you mentioned the 83B election. Can you kind of dive into that a little bit more? And that's a fantastic question. The 83B election is essentially a tax form that you send to the IRS. Typically, any stock that is granted or awarded to you, you may have the option to elect what's called the 83B election, the form you send to the IRS saying, I am claiming this as compensation today, even though it's not fully vested. This is most common with the profit interest and the RSAs, which are restricted stock awards. Sometimes they apply to RSUs, but you just want to double check on that. And that's where you essentially file that 83B election, claiming that income today. Most of the time it's, a $0 spread between fair market value and your exercise price in the example of options. And then from that point forward, it is all capital gains. So it can be much more efficient to utilize that 83B election, again, if it applies based on your individual stock plan. So that's a great question as well. Any other questions? I think we got all of them that were answered in the Q&A. But like I said, if there's any others that come up that are more specific to your situation, feel free to reach out. More than happy to meet individually over Zoom, or you can come to our office in person in South Salt Lake and we can go through your specific equity grant agreement, help you make that plan and set you on your path going forward. But if that's all the questions for today, then thank you for spending some time with us and keep an eye out for next month's webinars. Have a great day, everyone.